There are two types of assets. So you get the non-current assets and you get the current assets. Okay, so now these are your non-current assets. Your non-current assets are long-lasting resources or possessions of the business, like the property, buildings, vehicles, and equipment. Generally, you keep them in the business for 1 year or a longer period. So it's something that you invest in for a longer time. And then I've put some pictures here. So you can see that these are buildings and this is a car. So these are examples of the non-current assets that we have in the business. So if these are the non-current assets that we have, then you ask yourself, what are the current assets that we have in the business? So that's in the next slide. The current assets consist of the cash, which can be items which can be converted into cash in the short term, less than a year. So your things like the stock that you have in your business, so that is easily convertible to cash within less than a year. Your debtors, so the people who buy from your business, and they pay you on different terms for 30 days, 60 days, or 90 days. So they owe you money. So that is your right to receive your money, and they will pay you. The 30, 60, and 90-day period is less than a year period, you see? So they are also your current assets. And your cash and cash equivalents, that is the cash that you have in the business, the amount in your bank account, that is also part of your current assets. Okay. Now it brings us to the question of why are assets disposed? So the asset disposal, the whole concept, it doesn't deal with your current assets. It doesn't deal with us disposing the current assets. So it doesn't deal with us disposing the inventory, the debtors, or the money. So the asset disposal, the purpose of that is because the purpose of the asset disposal is to get rid of the assets in the business that we keep for longer, for 1 year or longer. And then you'd want to know why. Why would you want to get rid of these assets? So as you can see here on the slide, the assets could have become old or obsolete. So if you have an old computer system and there's advancements in technology, so you would want to keep up with the new computer system, so you would be able to keep up with your competitors. So that is one of the reasons why. The second reason here is running costs of keeping the asset may be too high. So for example, if you've got, you've got a motor vehicle and it's past its service warranty or maintenance plan. And so now it's not under its plan. So you have to pay out of your own pocket to get this motor vehicle to be repaired and fixed up and all of those things. So then people will just maybe fix it up and then they'll sell it and they'll buy a new one, because the old one, it's costing them more. There's more money being spent in the business to maintain the old asset, whereas if they get a new one which is under a service plan or maintenance plan, they wouldn't have to be taking out so much of their own personal money in order to run the cost of that asset. The third thing that we've got here is the business wants to keep up with the latest trends in technology. So it's similar to this point here where the asset has become old or obsolete. So same thing with the computer, or they use machinery, for example. If you've got a manufacturing business and they've got a machine that can make, let's say, 1,000 items in an hour, and there's a newer machine that is able to make 5,000 items in an hour. So there's 4,000 additional items that can be manufactured in an hour. So they'll be able to produce more. If you produce more, you'll be able to sell more. So they'll want to sell the old machine that would be able to produce the 1,000 items um, per hour and to purchase a newer machine that will be able to um, manufacture the 5,000 items per hour. Okay, so moving on to the next slide. Okay, so I've got here these different definitions on each slide. Have you understood everything so far? Do you have any questions?
No.
Okay. Okay. So now we're going to the cost price of an asset. So there's a reason why all these definitions are here is because all these items deal with the actual asset disposal. So the cost price of an asset. So this is the original price paid for the asset, including any cost incurred in the acquisition of the asset, which is transport costs, registration costs, and installation fees. Okay, so let's say, for example, on the 1st of January 2020, this year, we decided that we needed to buy an aircon, and the aircon costs us 5,000 Rand. So that is the purchase price that we paid for it. It will cost us, let's say, we bought it from PMB, so it's going to cost us 1,000 Rand to transport that aircon from PMB to Durban. So from 5,000, now the cost became 6,000. And then when it's here at our house, we aren't able to use the aircon just like that. We'd have to get an aircon installer to come and install the aircon for us, and then they would charge us another additional 1,000 Rand. So remember, we paid 5,000 Rand originally to purchase the aircon. So that was the price that we paid, the purchase price. Then we ordered from PMB. So that was an additional 1,000 Rand in order to get the aircon from PMB to Durban. So that is 6,000 Rand. And then we had to pay an additional 1,000 Rand to an aircon installer or aircon installing company for us to install that aircon into our home. So that's additional 1,000 Rand for that. So if you look at that, it's the 5,000 plus this additional 1,000 for transport, which gives us 6,000, plus the additional 1,000 for installation, and that gives us 7,000 Rand. So in total, it costed us 7,000 Rand. And in the cost price of an asset, you always include any costs that were incurred or a cost that we had to pay in order to get that asset, that aircon, into a condition that we may be able to use it. So just getting it here, remember, we were unable to use it without paying the transport cost to get it from PMB to Durban. We would have been unable to use it. So that is why we add in those additional costs, that additional 1,000 for transport and the additional 1,000 for the installation. So the total cost price of the asset then on the 1st of January 2020 will be 7,000 Rand. Okay, so that is the concept of the cost price. It is the price that you have paid to get the asset into a condition, so the installation, and to get it to the location, so that is Durban, to bring it into its use for us to enjoy the use of the aircon. Okay, So the next term we've got here is depreciation. So what is depreciation in terms of accounting? So it is the allocation of the value of the asset over the useful life of the asset. So let's say we've got this acorn now, and we able to see that for the next 7 years, would be able to use it for the next 7 years. So those 7 years becomes the useful life of it. And if we have to allocate a value of the asset over the useful life, so we buy it on the 1st of January 2020, and by the 31st of December 2020, if we have to sell that same acorn to someone, they're not going to pay us 7,000 Rand for that acorn which we've paid at the beginning of the year. And why is that so? That is because the value of that acorn has depreciated because we've used it over time. So we've used it could be leaking, or it could not work at its full capacity that it worked at originally. So the accounting term for that is depreciation, where the actual wear and tear, where it lessens in value. That is the accounting term for it. Okay, so it also says here, it indicates how much of the value of the asset has been used to generate income in a specific period, and which part of the cost of the asset can be used as a tax deductible expense. Okay, you don't have to worry about the tax deductible expense part at the moment. For now, we're just going to focus on the part where the depreciation, it means that the value of the asset is going to lessen over time. So we're just focusing on that concept. Okay, so the depreciation is written off according to two methods. So there's two ways which we able to do the depreciation, which the first one being the fixed percentage on cost price or straight line method, fixed amount method. So there's different names for this one. It can be called cost method or straight line method. I'm not sure what they call it in your school. There's different terminologies for it, but if you see any of these terms, fixed percentage or cost price or straight line, it's the same thing. Being a fixed amount that is going to depreciate every year, and we will do examples on these two different methods today, just at a later stage after I'm done with the concepts. The second method being the diminishing balance method or percentage on carrying value. This is the second method. So I'll just explain it to you. So for example, the acorn, so it's over 7 years, right? So in the first year, it would depreciate, let's say, by 1,000 Rand. So at the end of the year, it would be worth 6,000. And in the following year, okay, let me not confuse you now. Let's do that example that I spoke about later about the diminishing balance method. Okay, now we're doing this next term is called accumulated depreciation. The word accumulated means, this is the important word, is accumulated depreciation. It means things which are added up together. So it means from the first year to the second year to the third year, accumulation, all of those things added up together, and depreciation. So this is the depreciation, right? If we go back to this slide, this one was just depreciation, okay? Just depreciation. So if you see here, sorry, the next slide, it says here accumulated depreciation. So it's the depreciation which we've worked out over here on the previous slide, this depreciation, for the different years that we've used it, okay? So it will be for year 1, year 2, year 3, year 4, up till year 7. All of that depreciation is accumulated depreciation, where we add all the depreciation up. Okay, so the accounting terminology is the total depreciation written off on a specific asset up to a specific date, that is the total value which was used. Okay, so let's say at the end of the second year of the same aircon, which costed us 7,000. So let's say that the depreciation in year one was 1,000. The depreciation in year two was 1,000. So that would give us the accumulated depreciation. What we said was accumulated depreciation, all previous depreciation added up. So that is the accumulated depreciation. Okay. Would then be 2,000. Okay. Let us go to the next slide. Okay. Now we are going to carrying value. So the accounting terminology is the remaining value of an asset or the part of the cost of an asset not yet written off as an expense. So what this actually is your cost price less your accumulated depreciation is your carrying value. Okay, so let's go back to this original price here. Cost price of an asset, the original price paid for the asset, including any cost incurred in the acquisition of the asset. That is the transport cost, registration cost, installation fee. Remember the aircon example? It was the 5,000 Rand plus the additional 2,000 Rand, 1,000 being for transportation and the other 1,000 being for installing it. So that was 7,000. Okay. So that was the cost price. Remember that? Now we've got less the accumulated depreciation. We go back to the accumulated depreciation slide. What's on the slide, it says all previous depreciation added up. Okay, that is your accumulated depreciation. So back to the carrying value slide. Your carrying value is your cost price less your accumulated depreciation. So if we have to say, for example, with that aircon, we worked out our cost price to be 7,000. So our cost price was 7,000. We minus from that the accumulated depreciation. So let's say after 2 years that the accumulated depreciation was 2,000. So it's going to be the cost price of 7 minus 2 to give you a 5,000 Rand carrying value. Another important concept that's in accounting is the minimum carrying value to be used in the records is 1 Rand. So for example, let's say at the end of 8 years, you've still got the aircon, it's still working fine, and you don't want to replace it, or you don't want to it's not broken, you don't want to change it for a newer model. So what this means is after the period is over, the 7-year period was over, and we wrote off 1,000 year every year, in actuality the carrying value would be null, because it would be this 7,000 minus the accumulated depreciation of 7,000. Remember we said at the end of 7 years it's going to be 7,000. So if you take 7,000 minus 7,000, you're going to get 0. But in accounting, you can never show an asset at 0. So one of the things that's in accounting is that the minimum carrying value to be used in the records is 1 Rand. So you're still keeping on this aircon after the 7 years. So in your balance sheet, you're going to show your aircon valued at 1 rand. Okay, you're not going to show it at 0 rand, because you don't ever show anything as a null value for an asset. Okay, moving on to the next slide. Okay, an asset register. An asset register lists all the details of each asset and assists the business to keep track of each fixed asset's correct value. It is important for the control over assets and decisions about the economic value of assets. So what the asset register actually is, it's a document, or people use books in their business where they write the date that they purchased the asset. They write for how many years they want to use the asset. They write how much percent would they want to depreciate the asset over a certain number of years. So all of that is written in there, in that asset register, and it would have like a unique number. For example, if you buy a car, then it would have the license plate of the car in there. So each item, each asset will have a unique number. So it also helps for businesses to keep control over the assets. So it also helps to prevent theft, and if anyone is stealing from the business. So you would see, if you're supposed to have these number of assets in the business with this registration number and this unique code, you should have that many. So this is the book in which we keep it, the asset register. So there's different forms like in businesses. Okay, this was the example of depreciation. Before we move on to that, you can just let me know if you have any questions. Do you have any questions?
No.
Okay. Okay, so this is an example of depreciation that I told you that earlier on that we would do. So this is a vehicle. So a vehicle was purchased on the 1st of March 2020.1 for cash at 200,000 rand. 200,000 rand, and the financial year ends on the 28th of February. Okay, so the accounting period is from the 1st of March 20.1 to the 28th of February 20.2. Okay, so in this example, the depreciation is at 20% on cost price. So what do we do here? How do we calculate this depreciation? Okay, so for the different year ends, so depreciation as at the 28th February 20.2, 20.3, and 20.4. Because this is the cost price method or the straight line method or the fixed method where the depreciation is fixed at a certain percentage every year, the depreciation is going to be the same for every year. So you work it out by taking the cost price. So it costed 200,000 rand. Okay, so the vehicle's cost was 200,000 rand times the straight line percentage. Here it is 20% per annum. Okay, so it's 20% times 200,000 times the 1 year. Okay, you remember to always apportion this. It's very easy to forget sometimes to not multiply something by half a year, or 3 out of 12 months, or 4 out of 12 months, or 9 out of 12 months. So it's good to write 1 over here, or even 1 over 1. So you remember the step that you have to multiply it by the actual number of months and actual time that you've had the asset, because it is really easy to forget, especially in a test or exam condition when you are stressed out. So just get in the habit of writing this 1 also. Okay, so this 20% times 200,000 times 1 would give you the 40,000. And as we said, because this is the straight line method on the cost price, every single year, so for the year end 28 February 20.2, 28 February 20.3, and 28 February 20.4, the depreciation for all these years is going to be 40,000. So then it brings us to the next question. Remember we spoke about the accumulated depreciation. So the depreciation for 1 year is 40,000. So if you want to know the accumulated depreciation at this date, the 28th of February 20.4, what would it be? So it'd be 40,000, 40,000 for the year 20.2, 40,000 for the year 20.3, and 40,000 for the year 20.4. So if we add all that up, 40,000 plus 40,000 plus 40,000, it's going to give you 120,000. Okay, that is your accumulated depreciation for the year ended 28 February 20.4. So this was the straight line method. Now we're going to go into the diminishing balance method. Okay. So it's still the same car that we're dealing with as in the slide here. The vehicle was purchased on 1st March 20.1 for cash at 200,000 Rand, the financial year ending on 28th February. The only difference between this slide and the next slide is here the depreciation was at 20% per annum on cost price, and in this scenario the depreciation is at 20% per annum on the diminished or diminishing balance method. Okay, so in the first year the depreciation is 20% times 200,000 times 1 over 1 of 1 year, which gives you the 40,000. If you'll notice something with the diminishing balance method and the straight line method, in the first year, the depreciation amounts are always the same. So here, 40,000 in the first year. If you go here to the straight line method as well, you can see for the depreciation on 2020.2, it was also 40,000 there. So the first year is the same. The difference between the straight line method and the diminishing balance method comes in the years after the first year. So if you see this information here, it says depreciation on 28th February 20.3. Okay, this is where the difference comes in. We still use the same percentage, 20% times 200,000 here, which was 200,000 being the initial cost of the vehicle. The difference comes in where we have to subtract this 40,000. Why do we subtract this 40,000? Because this 40,000 is the previous year's depreciation. Okay, so because it's the diminishing balance method, diminishing means it lessens. So when something lessens, it means with this method, the depreciation for each year is going to decrease. So because of that method, what they do is they minus the previous year's depreciation. So it is the 40,000 here. So the same 40,000, they took it here, 20% times the 200,000 minus the 40,000 times 1 over 1, and it gives you 32,000. And you can see the difference here. In the first year, the depreciation for 28th February 20.2, this was 40,000. In the second year, the depreciation diminished, it decreased to 32,000 Rand. Okay, because why? We minused this 40,000 here from the 200,000 Rand. And we do the same procedure in the third year. So this is the third year. So we also going the percentage is standard 20% times 200,000. This being the cost price of the vehicle. We minus the 40,000. The 40,000 comes from here. The first year's depreciation minus 32,000. The 32,000 comes from the second year's depreciation times 1 over 101, and that will give us 25,600. So see, in this step we minused the 2 years, the 2 previous years worth of depreciation. And as you can see here is that this has decreased, this number has decreased. So in the first year was 40,000, the second year was 32, and now in the third year it's decreased further to 25,600. So now we look at what is the accumulated depreciation in terms of the diminishing balance method. Okay, you're going to add the 40,000, which is this. You're going to add the 32,000, which is this. And you're going to add the 25,600, which is this here. And when you add all of them up, you're going to get 97,600.